No shots have been fired, no troops have been mobilized. And yet, we are in the midst of a war, silent, invisible, and brutal. Since the end of World War II, the US dollar has reigned supreme as the currency that defines the value of the world. But that reign is under attack. China, Russia, Japan, and India, each in their own way, have already begun the quiet withdrawal of their bets on the American financial empire. In 2025, Japanese investors sold over $20 billion in foreign securities, including American assets, a response to the instability triggered by economic tariffs. Meanwhile, China is slowly reducing its exposure to the dollar, striking trade deals in yuan with dozens of countries. The BRICS nations are discussing a new currency. And the United States? It responds with tariffs, sanctions, and high-stakes diplomacy. We are facing a new Cold War. But this time, the battlefield is the central banks, and the weapon is currency. In 1944, while World War II was still raging in Europe, a quiet conference in Bretton Woods, United States, sealed the fate of the global financial system. What was born there was not just a monetary agreement, but the consecration of the dollar as the world's reference currency. Backed by gold and the economic strength of the US, the dollar became the official language of international trade, foreign reserves, and sovereign debt. Decades later, even after the end of the gold standard in 1971, the dollar continued its reign, sustained not by trust in metal, but by the power of the United States. Today, around 58% of global foreign exchange reserves are still held in dollars, according to the IMF. In the 1970s, amid the oil crisis and inflationary pressure, the US struck a quiet pact with Saudi Arabia and other OPEC countries. Oil would be traded exclusively in dollars. Thus was born the petrodollar system, reinforcing global demand for the American currency. Every barrel purchased required dollars, fueling a cycle in which all countries needed the one currency only the US could print without real external backing. This dependency created a kind of global invisible tax, where the US issues debt and the rest of the world finances it without the power to resist. According to data from the Brookings Institution, this strategy allowed the US to sustain massive deficits without collapsing. The dollar's use goes far beyond trade. It has become a geopolitical weapon used by the US to sanction adversaries. By controlling the SWIFT system, the main international payment network, Washington can block entire countries from global transactions, as it did with Iran, Venezuela, and Russia. This ability to financially punish without firing a shot is part of what's called the US's extraterritorial monetary power. As the Financial Times has noted, more and more countries are seeking to shield themselves from this dominance, creating parallel systems to survive in a financial world designed in Washington. For the US, a strong dollar is a symbol of power, but it also comes with contradictions. A stronger dollar makes American exports more expensive, harms domestic industry, and creates trade imbalances. For the rest of the world, dependence on the dollar is a systemic risk. Developing countries that issue external debt in dollars become vulnerable to currency crises, as seen in Argentina, Turkey, and Sri Lanka. The World Bank estimates that over 60% of low-income countries' debt is denominated in dollars, making them hostages to the decisions of the Federal Reserve, the central bank of a country they did not elect. Though still dominant, the dollar is under attack. China, Russia, and the BRICS nations are working on bilateral agreements using other currencies. The yuan, though not freely convertible, is already used in bilateral transactions with over 25 countries. The IMF has already included the yuan in its SDR, special drawing rights currency basket. Even US allies are beginning to question, how much longer should a single currency dictate the course of the global economy? The dollar's supremacy was built on the rubble of World War II, but in a multipolar world, the throne may finally be starting to crumble. For decades, Japan and China, strategic and economic rivals of the United States, played a paradoxical role, acting as creditors to the very empire they sought to challenge. By purchasing trillions of dollars in US government debt, known as treasuries, these nations helped sustain America's deficit-driven lifestyle, and, in doing so, strengthened the dollar. The reason was clear: to protect their own interests by ensuring market and export stability. In 2022, China held over $1.1 trillion in treasuries, while Japan peaked at $1.3 trillion. In recent months, that picture has started to shift, subtly but significantly. Japan, the largest individual holder of U.S. debt, made targeted sales of foreign bonds in 2025, totaling more than $20 billion in April, according to the Financial Times. The official explanation was the need to defend the yen from global inflationary pressure and the volatility triggered by U.S. tariff announcements. Although the volume doesn't yet signal a structural withdrawal, analysts view it as a warning sign. Even Washington's longtime allies are beginning to reassess their financial dependence on the U.S. A gradual rebalancing of Japan's reserves is now under discussion, not as retaliation, but as a quiet diversification strategy. China, for its part, has acted with greater discretion. Though it remains one of the largest U.S. creditors, it has been steadily reducing its exposure and diversifying reserves into gold, euros, and bonds from strategic partners. It has also accelerated bilateral agreements in yuan with countries across Asia, Africa, and Latin America. According to Reuters, Chinese holdings of treasuries are now at their lowest level since 2009. There is a growing consensus among analysts China does not want to be vulnerable to sanctions or asset freezes like those imposed on Russia. In a potential escalation over Taiwan, dependence on the dollar could prove fatal. The financial market's main concern isn't just the volume, it's the speed at which these bonds could be sold. If China or Japan were to dump treasuries on a large scale, their value would plummet, interest rates would soar, and the dollar could spiral into devaluation. The IMF and World Bank have warned that such moves could trigger a global confidence crisis, especially in a context of mounting U.S. debt. The question then is not if these countries will sell, but when, how much, and with what intent. Curiously, even amid these signs of retreat, the dollar still strengthens during crises. This is due to the so-called safe haven effect. Global investors flock to treasuries in times of uncertainty. That paradox gives the U.S. a false sense of invulnerability, allowing it to keep expanding its debt, which surpassed $34 trillion in 2024, according to the U.S. debt clock. But the warning signs are there. Creditors' patience is running thin. And if the dollar loses its special status, the U.S. may have to learn, for the first time, what it means to be a debtor in a system it no longer controls. For decades, the US dollar reigned supreme as the world's reserve currency, medium of exchange, and geopolitical instrument. But a growing and carefully orchestrated trend has been gaining momentum: de-dollarization. Countries once entirely dependent on the US-dominated financial system are now seeking alternatives to escape Washington's control, driven by unilateral sanctions, currency instability, and trade disputes. China, Russia, and the BRICS nations are leading this movement. In 2023, less than 60% of global foreign exchange reserves were held in dollars, the lowest level in 30 years, according to the IMF. China has been aggressively promoting the international use of its currency, the yuan. From bilateral agreements with Russia to oil imports from Saudi Arabia, the yuan is increasingly present in strategic transactions. In 2023, China and Brazil signed an agreement to ditch the dollar in bilateral trade, following similar arrangements with Iran, Pakistan, and other Asian and African countries. According to the South China Morning Post, over 40 countries already use the yuan in some form in their reserves or international trade. Although the yuan still faces limitations, such as a lack of full convertibility and strict state control, its global use is growing, fueled by a clear geopolitical strategy. The SWIFT system operates as the nervous system of global finance. Controlled by Western nations, particularly the US, it enables tracking and validation of international transactions. But its use as a sanctions tool, especially after Russia was cut off in 2022, triggered global alarm. In response, China and Russia have developed alternative systems: China's CIPS, Cross-Border Interbank Payment System, and Russia's SPFS. Though still modest in scale, these networks already enable transactions outside Washington's reach, challenging SWIFT's monopoly. As Reuters noted, this shift represents a new invisible financial battleground. At the 2023 BRICS summit in Johannesburg, leaders like Xi Jinping, Lula, and Vladimir Putin openly discussed the creation of a common currency for member transactions. While still at a conceptual stage, the project gained symbolic and diplomatic traction. The idea is to establish a unit of account tied to a basket of member currencies, similar to the IMF's SDRs, to avoid dominance by any one country. The Financial Times highlighted the immense technical challenges involved, but the political goal is clear: to build a counterweight to the dollar and accelerate the de-dollarization of global financial flows. In the silent battlefield of the global economy, exchange rates have become strategic ammunition. Countries manipulate the value of their currencies to boost exports, attract investment, or cushion external shocks. This often covert practice is known as currency manipulation, and it has become a subtle form of economic warfare. According to the U.S. Treasury Department, countries like China, Japan, Switzerland, and even Germany have been investigated for artificially interfering with their currencies. The line between legitimate monetary policy and deliberate manipulation is thin, but its effects are deeply geopolitical. Japan is one of the most studied cases of systematic currency manipulation. Since the 1980s, the country has adopted policies to keep the yen undervalued against the dollar, encouraging exports of technology, vehicles, and electronics. In 2023, amid global inflation and a strengthening dollar, the Japanese government directly intervened in the market by selling dollar reserves to support the yen. This strategy was criticized by Washington, which accused Tokyo of artificially weakening its currency to gain trade advantages. According to a Bloomberg analysis, Japan spent over $40 billion in just 3 months to defend its currency, a figure that underscores the scale of the ongoing currency war. China is the primary target of U.S. accusations of currency manipulation. Although the country officially abandoned a fixed exchange rate policy in 2005, its central bank still frequently intervenes to manage the yuan's appreciation. Between 2005 and 2014, the yuan appreciated about 30% against the dollar, but since then its movements have been tightly controlled. During the trade war initiated by Trump, the yuan's depreciation was interpreted as a strategic retaliation, making Chinese goods cheaper and more competitive. As the BBC noted, manipulating the exchange rate is as effective a weapon as a tariff hike and much harder to trace. Currency manipulation often goes hand in hand with interest rate policy. Central banks maintain artificially low rates to avoid currency appreciation and stimulate domestic consumption. The problem is that such policies in developed countries can trigger capital flight from emerging economies, devaluing their currencies and importing inflation. Countries like Brazil, South Africa, and Turkey have suffered from this kind of instability. A study by the OECD showed that 80% of currency crises in the past 30 years were preceded by external monetary shocks from decisions made by the Fed, the ECB, or the Bank of Japan. In other words, manipulation doesn't always come from the usual suspects. Interestingly, a strong currency, a traditional symbol of stability, can actually be harmful in times of global competition. The euro, for example, appreciated against the dollar in 2022, hurting German exports and putting pressure on heavily indebted countries like Italy. The US, while benefiting from foreign capital inflows, saw its manufacturing sector suffer under a strong dollar, harming small and mid-sized exporters. The search for the exchange rate sweet spot has become an obsession for economic policymakers. But when everyone tries to devalue their currency at the same time, no one wins. And the result is an unstable environment where trust, not rates, defines the future of money. For nearly a century, the US dollar wasn't just a currency, it was the anchor of the global financial order. But what if that anchor begins to give way? The signs are everywhere. A decline in the share of international reserves held in dollars, the rise of alternative currencies, growing mistrust in US debt, and the overuse of the dollar as a tool of sanctions. A study by the Bank for International Settlements suggests that the world is heading toward a multipolar monetary system where multiple currencies coexist in positions of influence. The dollar's fall wouldn't be sudden, but if accelerated, the impact could be global and disruptive. For the United States, losing the dollar's hegemony would have deep consequences. The country would no longer issue debt at negligible costs, would face a significant devaluation of its currency, and would have to compete for global trust, something it has taken for granted for decades. The American fiscal deficit, currently over $1.5 trillion per year, would become unsustainable without the guaranteed demand for treasuries. Moreover, the exorbitant privilege of importing with its own currency would disappear. As the New York Times noted, the end of the dollar era would force the U.S. to face its structural vulnerabilities and to redefine its role in the world economy. For the rest of the world, the dollar's decline could be a double-edged sword. Highly dollarized countries, like Ecuador, El Salvador, or some African nations, would face monetary chaos and an urgent need for transition. Dollar-denominated external debts would become more expensive, and imports of energy and food could skyrocket. On the other hand, nations with reserves in gold or alternative currencies, such as the yuan or euro, could benefit from a redistribution of financial power. According to the World Gold Council, central banks increased their gold purchases by 34% in 2023 as a hedge against a potential post-dollar era. The future of the monetary system may not belong to a single currency, but to a network of sovereign digital currencies and real assets like gold and tokenized commodities. Countries like China, India, and Nigeria are already testing central bank digital currencies to escape the traditional financial system. The digital euro and digital yuan are in advanced stages. Meanwhile, regional blocs like BRICS, ASEAN, and MERCOSUR are discussing currency integration and local reference units as a way to regionalize trade. The Financial Times suggests the world is moving toward a system more like the internet, decentralized, multifaceted, and competitive. The truth is, the dollar is unlikely to disappear, but it may lose its sovereignty. The future of the global economy seems to be heading toward a more unstable, yet more distributed balance. Instead of hegemony, interdependence. Instead of monopoly, competition. The money war will not be won with tanks or missiles, but with trust, liquidity, and compelling narratives. And that war has already begun. The real question is, are we ready to live in a world where the dollar is just one currency among many?